What could stop the housing boom? Let's have a look. Hello everyone, Florian.heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee, because I want to have a talk about this article written by Tarek Brooker in news.com.au. The two factors that could halt the Aussie housing boom. Okay, hang on, wait, I need to get my highlighter going. There we go. Hang on, wait, polished operation. There we go. I need to do that, guys. So, before we go into that, let's have a look at current house asking prices, at least from SQM's perspective. Now, the capital city average is at $1 million, guys. $1 million for all houses. The national average, because that takes account of the regions, you know, those poor regions that can't have their $1 million houses, they've only got their $650,000 houses. I actually saw a meme on Twitter. You know, if you had bought 10 bitcoins, you know, or 100 bitcoins 10 years ago, 10 bitcoins 10 years ago, you could afford this Australian house, and it was the duplex that the guy bought in half. Yeah, so there you go, that's Australia, guys. And I've got an update on that one that I'll talk about today. Sydney, oh poor Sydney, 1.4 million for all houses. 3-bedders, 1.3. You know, you get a little cheeky little 3-bedder. Just think about this. I'm renovating my house. We'll technically have 9 bedrooms. 3-bedder. You can't have a big family in that. We're doing it right now. Melbourne, 1,965,000 for 3-bedders. Units are down the bottom. And good old Brizzy, 675, 577 for 3-bedders. So that is the current house asking prices according to SQM. So let's talk about housing affordability, everyone, because those prices, or those asking prices, are pretty high, and they've gone up a significant amount. Now, houses are up over 500%, 565 in 30 years, okay, since 1990. I'm old enough to remember 1990. What was it? Oh, Nintendo, and the internet was just appearing. They're showing my age here. But in Sydney, you went from 173,000 to 1.1 million in September. 565% growth. Melbourne 137 to 846, which is higher now, 518, and Brisbane 100 grand to 539, 408,000. And everyone else is the same. Darwin is the lowest at 336 there, 36%. Hobart's gotten even worse than this. Units, same thing. Everything over 400% except for Brisbane. And you know, that could be because we've had oversupply of apartments spring up in South Brisbane. So look at those percentages. Just remember those. This is wages. Average weekly earnings from $550 for a bloke to $1,770. And that's not everyone. And that's a 322% rise. So if you're seeing this $1,770 a week and think, wow, I'm not getting that, what's going on? Guys, there's a bit of a, class difference in Australia in earning capacity, and it's growing. It is definitely growing. Women the same. They're up. They've actually gone up higher than men, 335%. So this is just the differences in what percentile you are and your mean income per week, everyone. So you can see here that there's definitely a big difference that's growing for Australians. And that will affect the amount of disposable income you have. That will affect your quality of life. That will affect your education you can have to a big extent. Although I think in some ways education is getting a lot cheaper, particularly the way we're doing it and the access to information you have. And but it's also going to affect your chance to get into housing. So we've got not just a K-shaped recovery, which I honestly think we're having here in Australia, because some sectors, some people are not even feeling it. They're flat out, they're really busy, while others are just dead. But I think that's also a growing divide in different parts of our society. So this is first home buyer affordability based on 30% of your disposable income. So 30% or less of your disposable income if that's your mortgage payments. And considering if you're above this line, you've got access to, here in Brisbane, at this time of this chart, about 70%, you had access to about 70% of the housing on the market. So 70% would be considered affordable. Everything else below the line isn't. It's going to take more of your income. You can see here, Perth as well, there was a few. So housing affordability, at least measured against the old 30% of your disposable income, is not really common through all of Australia, and I think we can agree to that. But first home buyers are leading the market, guys. They're the ones that are jumping in, juicing up the market because they want to get in those houses. And I don't blame people. You want a house, you want a stability, you want a home, even if it's a dump that you got to fix up like we have. But you want something. And it's even a freehold, a bit of land that you can have, you can pass on to your children. Sure, you've got to pay rates and all these expenses, but just make sure you take it. I kind of like someone rocking up and taking my garbage away. It's one of the few useful things the council does. It's why I honestly think local council level is probably the most important political level, and we should have more power at that level. But anyway, off topic. But first home buyers are just juicing up the market. And this is house price indices from around the world. We're not alone in just insane property price growth, but they've just taken it back to 2017 here. This is from the RBA. So I'd like to see this chart a bit further, how it would look then. Wherever you set the 100 can make a difference. Look at New Zealand, everyone. Poor Kiwis. So this has all happened because of government to the rescue, government intervention. So government are causing all these issues, and you'll have people calling for more government. Like we've got home builder juicing up the cost of building materials, so people are calling for government to intervene to give subsidies to the transportation cost of it. You can't make this stuff up. So how's government been to the rescue? They've been keeping zombie companies alive, everyone. JobKeeper up nearly 9% at one point of those employed were on JobKeeper. Trading while insolvent has resulted in companies under external administration at a lower level, about half of where it should be. Look at that trend line. And if that just goes back to normal, we're going to feel it. It's going to be noticeable. And there's predictions about 5,000 companies going insolvent over the next 12 months. What worries me is the business owners that have tried to do the best by their staff, have kept bringing the JobKeeper in, but then the staff, getting this token payment and are happy with it. But then people realize, oh, wait a minute, you've got this huge super bill. You've got all these entitlements that you still have to pay. And then people start losing their homes. That's what worries me. That it's kind of been a cruel trick. The government has kept people going when maybe you should have just fired people and then built up again. But I know why they did it, and I know why people are going to be in this position. They're juicing the market, guys. They always do. This is the intervention that they do. The cash rate is a joke. Building approvals have shot up to insane levels because of home builder, everyone. You've got governments handing out money left, right, and center at state and federal level. You've got the 5% government loan guarantee. That scares me, that the precedent that is setting. I'm worried. I'm worried we're going to head down the path of America. You've got the super withdrawals. A lot of people used it to pay off debt. That's what most people used it for. I know the media, and then I'm seeing everything from all the super companies. So I've signed up to the press releases, and you see the propaganda coming out of the union-controlled super companies just trying to manipulate all these newspaper articles, like women in Townsville will be down on super, all this stuff, because they want to control your money, because we're too stupid to control our own money. I'm not against super, but I think it should be voluntary, because we're going to hear more and more stories about businesses going under and people complaining about super theft, not getting paid. Anyway, and negative gearing, good old negative gearing here in Australia, which is juicing up the market as well. So, reduced housing supply, councils limiting developments, loan deferrals, and just uncertainty in the market as well. So all of these things are coming together with the government to the rescue. But remember, you don't get a free lunch, guys. Not even at the hippie, bloody vegan restaurant that was underpaying staff and not paying super. That lunch wasn't free. You were eating someone's super contributions when you were there, feeling good. Okay, just remember that. It's like all these airy-fairy leftist businesses just don't get it, do they? Anyway, national net debt will hit 1.29 trillion in 23-24. Just remember that when people are saying ScoMo saved Australia with home builder, or Joshi saved Australia, just remember this. Okay, so let's have a look at Tarek's article. 2 factors that could halt the Aussie house price boom, everyone. So I'll get my blue highlighter here. So this time last year, There were fears from economists and the major banks that Aussie house prices could crash, with predictions of up to 32% price falls coming from even the most mainstream of forecasters. And remember, the RBA, they had even released modeling of a potential 40% crash. Now, I'm putting my aluminium foil hat on, thinking that perhaps that was a coordinated effort to nudge our political leaders for drastic intervention in the economy. You know, for the job keeper, for the home builder. Hey, you know, I better trademark mortgage keeper, guys. What do you reckon? And job maker as well. You think you think there could be some merit to that? Now, 12 months later, you'll be hard-pressed to find any forecaster expecting lower housing prices in the short term, let alone a historic housing crash. According to figures from house price data provider CoreLogic, housing prices are currently rising at the fastest rate since '88, a time when the average Aussie home could be purchased for around $100,000. That just seems quaint now, doesn't it? And it probably would have been a nice little home. There's one thing we also have to consider. The houses would have been smaller back then too. And everything would have been painted in mission brown, at least in Victoria. Can you still call it that? But as the global economy continues down the long path to recovery from the pandemic, there is a threat on the horizon that grows more concerning for the Aussie housing market with each passing day: inflation, or in some cases, the expectation of future inflation. So how does inflation impact house prices? Well, it already is. Demand, and well, right now we've got inflation in building materials. Timber, the futures are up 180%. Shipping costs, freight costs around the world are up insane amounts, like $5,000 to send it from China to America. It's just nuts. It is really, and that's a supply cost that's going to inflate the prices of housing here in Australia, particularly with how much imported stuff is brought into here. And also the timber is to do with demand. The demand for the timber is up higher because of all the government stimulus, pulling that price up, and supply isn't at where it should be because of bushfires here in Australia and in the US, just people expecting the market to not need it. So then there's the ultimate, Inflation is the issue for the property market for two reasons. Once inflation exceeds the upper limit of the RBA's 2% to 3% target band, historically, pressure rises on the RBA to raise interest rates. Then there is the ultimate arbiter of global interest rates, the bond market. As inflation and expectations of future inflation rise, bond market participants generally begin to demand higher interest rates to offset the inflation eating away at their returns. With inflation expectations continuing to rise globally, and particularly in the United States, the bond market has already started demanding higher interest rates. Since hitting their crisis lows, the effective cost of the US government borrowing for 10 years has risen by up to 250%, with speculation continuing to grow that it could go even higher. As a result, the standard 30-year US mortgage rate has already risen by 0.53% in less than 3 months. But the expectations of higher inflation and rising interest rates may be just the beginning. Global supply chain disruptions, material shortages, and rising shipping costs are already putting significant pressure on manufacturers to raise their prices. And I've had viewers send me examples of one gentleman imports stoves and how he's had to say, well, prices are going to go up at this time next year because look at this cost increase. Look at this letter I'm getting from the shipping company I'm using. You know, are you putting up your prices, guys? I'll put a community poll on there to see how many of you have managed to put up your prices if you're in the construction game, or just what business you are because of increasing costs. I tell you, that's one of the advantages I've had of just scaling back our practice to just Rachel and I just working from home like some cheap bastard. It's awesome because my costs they've evaporated. All these costs, because you got rent and this and then staff and then wages and then equipment and we're lucky. I'm an architect. We just draw stuff, guys. We draw on a computer. I got software rental costs. I'd hate to be someone who's borrowing money to buy stuff to stick in a building and then have to wait 90 days, 120 days to get paid. You gotta love the construction industry, guys. You gotta love it. Oh, anyway. According to data from the Philadelphia branch of the U.S. Federal Reserve, prices paid by manufacturers have risen to the highest level since March 1980. We've seen that as well here in the latest PCI regarding the input prices for construction. They're higher. Expectations are higher there too. The Suez Canal effect. Now enter everyone's favorite green 200,000 ton container ship, the MV Ever Given, and its temporary home wedged in the eastern banks of the Suez Canal. After delaying traffic through one of the most vital waterways in the world for almost a week, many major European ports are already feeling the stress from the backlogs of ships delayed by the Ever Given's now infamous adventure. Caroline Becquard, Senior Vice President of Mediterranean Shipping Company, recently shared her thoughts on the issue with shipping news website Splash. We envisage the second quarter of 2021 being more disrupted than the first 3 months and perhaps even more challenging than it was at the end of last year. Companies should expect the Suez blockage to lead to a constriction in shipping capacity and equipment, and consequently some deterioration in supply chain reliability issues over the coming months. I mean, it's going to take some time to filter through, guys. And some people are saying, oh, it's thinking this was done intentionally. I don't know. Why? You can already blame everything on the pandemic, guys. I think it can be incompetence. You know, I don't know. A lot of effort for something which will have an impact, but, you know, we're already going to have impacts anyway. Biden's $2 trillion stimulus package. There is also another major potential driver of inflation that the bond market is very concerned with: U.S. President Joe Biden's stimulus package. Even as things sit today, there has been a pandemic-driven push towards consumers focusing their spending on goods rather than services. This has placed increased demand on manufacturers and importers already struggling to get the stock they need due to the global supply chain issues. So, and that's demand-driven inflation, exacerbated by supply issues. And now we're getting increase in the money supply too. That's going to have an effect. So the K-shaped consumer demand. So there's durable goods, non-durable goods, and services. So there you go. This goes back to what we're talking about, the different parts of the economy recovering, and that exacerbating the different parts of our society, the wealth disparities. With trillions of dollars, more stimulus, and I wonder how much of that is going to head right into Bitcoin. How much do you think? How many people are going to take their stimmy checks and put it right into Bitcoin? Maybe you try. I can understand why. If the government's just generating it from everywhere, it makes a whole lot of sense. Just sit it there and forget it. So with trillions of dollars, more stimulus still expected from the Biden administrator's infrastructure plan, and yet another stimulus package to potentially come after that, there are concerns this wash of cash could place upward pressure on inflation. But as the Democratic Party continues to settle into its new position of power, holding the White House and a majority of Congress and the Senate, there are a number of Democrats who want to do their best to impersonate a daytime TV infomercial with an impromptu, but wait, there's more. A group of 21 Democratic senators, a little over 1/5 of the U.S. Senate, asked President Biden to include recurring stimulus checks in his upcoming Build Back Better recovery proposal. Oh, is this a potential shift towards UBI, everyone? Is America really going to turn into California? I just keep thinking of the streets in San Francisco. Not paved in gold, guys. Different type of gold. Different type of nuggets. Prominent Congresswoman and left-wing standard bearer AOC has urged the Biden administration to go even further, stating that Biden's more than $2 trillion infrastructure stimulus plan should go way higher. She suggests in a recent interview that the ideal number was realistically $10 trillion over 10 years. She's just pulling that out of nowhere. With supply chain issues expected to continue for the foreseeable future in one hand, and the possibility of trillions more stimulus for the Biden administration in the other, concern continues to mount that inflation could drive government borrowing costs significantly higher. While the US Federal Reserve, European Central Bank, and a long list of economists believe the current supply chain disruption and stimulus-driven inflation will be transitionary, it's ultimately the opinion of the broader bond market that will decide the direction of global rates in the short term. But how does this all affect Aussie house prices? This brings us back to many Australians' favourite topic, housing prices. Yeah, we're obsessed with houses here in this country. If the inflation that results from US stimulus and global supply chain issues is short-lived and less severe than expected, then property investors can sleep soundly in the knowledge that the housing price boom is likely to continue. However, if the resulting inflation ends up being significantly more sustained and severe than expected, then it could be quite a different story. These are the two potentials here. Some people are arguing that the inflation risk will be short-lived in the US. Or is it just the first steps of hyperinflation? So, there are already warnings from the IMF that rising US interest rates could trigger overpriced assets such as Aussie housing to unwind in a disorderly manner. Tarek is pulling this from... Okay, they're talking about unwinding in a disorderly manner. They didn't specifically say Aussie housing in that warning. At least I didn't see it. Whether the property pundits will be right in predicting a boom this year, as they were wrong about a bust in 2020, remains to be seen. But as one looks out over our nation and the current rate cut-driven boom, one has to ask, if rate cuts-driven higher housing prices, what would higher interest rates do? Could you imagine that, guys? Could you imagine actually earning some money on the money you have in the bank? I mean, the hoops I am jumping through to earn 1.35% in my ING account is just, it's a joke. It really is. So, what are the solutions to this? Long term, and I'm going to say this again, we need to reduce our dependency on property as the driver for our economy. The problem is, everyone sees it as the way to get wealthy in Australia. Our politicians use it to stimulate the economy, and they want to use the wealth effect to get spending in other parts of the economy. What I would suggest that we look at doing, that people push for, or maybe some brave politicians might advocate, looking at special economic regions, parts of the country where we experiment with reduced levels of government intervention in the economy. What if you had a certain part of the economy where suddenly negative gearing disappeared, or the minimum wage was removed, or the tax-free threshold was increased? We've got to do something, guys. That's where I'm saying it'd be better to have a lot of these, well, a lot more freedom and flexibility and experimentation at a lower level. That's one advantage America has compared to many other parts in the world. The way their nation is set up, their republic, how each state can really experiment and test different things. That would be something I'd like to see here in Australia. What do you reckon? Anyway, thank you all for watching. Please like, share, and subscribe to the channel. If you're a fan and enjoy the content I create here, there are a few ways you can support us. You can join us on YouTube or Patreon. You can support us using our affiliate links on Amazon, eBay, Independent Reserve, or AussieBroadband. You can buy merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone. Have a great day, and I will see you all in the next episode. Bye for now.